Guide to choosing the best bank statement. Loan lenders. What is a bank statement loan? Also known as a stated income loan, a bank statement loan relies on your income history to assess your financial health. You won't need to prove the documents needed for a traditional mortgage, such as tax returns and W-2s. Instead, your bank statements will prove your income and ability to repay the loan. Since these loans are riskier than traditional options, they may have higher interest rates and down payments. To assess your cash flow, lenders will review your bank statements over specific periods, typically 3 to 6 months. Benefits of a bank statement loan. Bank statement loans are the perfect opportunity for non-traditional income earners to get a chance to buy a home. That's why they're also known as bank statement home loans. No traditional income verification. If your income streams aren't traditional, you don't have to offer proof with the help of tax returns or W-2s. Instead, you can use your bank statements to prove to your lender that you can return the funds. Accessible for self-employed individuals. You don't need a perfect credit score to qualify for a bank statement loan. Most lenders are willing to accept borrowers with a credit score as low as 620. This is great for self-employed individuals who haven't had the chance to build credit yet. Higher loan limits. Bank statement loans typically have higher limits than traditional options. That's because these loans cater to those with higher earning potential, making it easier for a lender to trust them. Types of bank statement loans. Bank statement loans aren't just limited to personal home loans. They're also available for business and commercial borrowers. Personal bank statement loans. Personal bank statement loans typically cater to self-employed borrowers. Asset depletion loans are a type of personal bank statement loan. In this loan, the borrower's assets are considered their source of income, which the lender uses to calculate their notional income and qualify them. 2. Business bank statement loans. Bank statement business loans rely on the company's revenue to assess their ability to repay the loan. Businesses with seasonal fluctuations in revenue can benefit from bank statement business loans. They don't need to provide a consistent, traditional source of income. The lender will simply account for the seasonal variations when qualifying them for the loan. Commercial real estate bank statement loans, also known as investment property loans. This type of loan caters to investors looking to refinance their properties. The lender will review the property's income based on its rental history and cash flow reflected in its bank statements. Bank statement loan requirements. Minimum credit score. Bank statement loans don't scrutinize your credit score as much as traditional options. Some lenders may even qualify you if you have a credit score of at least 620 or higher. Stable income. Proof of a stable income is the main requirement of a bank statement loan. In most cases, this can be reflected in your bank statements over a period of 3 to 6 months. These statements should include all the regular deposits attributed to your income. Self-employment or business ownership. Bank statement loans typically cater to business owners and self-employed individuals with irregular income streams. You'll need to provide proof that you're self-employed or own a business. That may be via tax filings, business licenses, and other such documents. Down payment. Bank statement loans typically have higher down payments than traditional mortgages. You can expect to pay a minimum of 10%, but some may even go as high as 20% of the property's value. Cash reserves. In some cases, the lender may require you to have some cash reserves. These additional funds ensure that you'll be able to cover the loan repayment in case you lose your income. Debt-to-income ratio. Bank statement loans are typically more flexible, but some lenders may still want to evaluate your debt-to-income (DTI) ratio. In such cases, they may prefer a DTI ratio of 43% or less. Proof of assets. If your bank statements aren't enough to prove your creditworthiness, you'll also need to provide proof of assets like stocks or retirement accounts. Preparing for a bank statement mortgage application. Gathering necessary documents. First and foremost, collect all the documents required for the loan application process. Bank statements from the past 3 to 6 months. Proof of ID, passport, driver's license, etc. Proof of address, utility bills, bank statements, etc. Income documentation, profit and loss statements, 1099 forms, etc. Business licenses, if applicable. Asset documentation, if applicable. Credit report. Understanding your financial situation. Before you take the plunge, assess your financial situation. Calculate your income and expenses as well as any outstanding debts or financial obligations. High DTIs can lead to rejections. Maintaining a good credit score. Your credit score is a major aspect of your loan approval. While the requirements aren't as strict, it still needs to be 620 or higher. You can maintain this score by paying your bills on time and avoiding new lines of credit.